We're delighted to be joined by collaborators from the FinTech Corridor. And I'm going to hand over now to Alan Costello, who's the Director of Resolve Partners and who also is on the board with the FinTech Corridor, who has kindly agreed to moderate our session today. So thanks, Alan. I'll hand over to you.
Thank you very much, Grace, and thank you for inviting this partnership with the FinTech Corridor, and we're delighted to be able to support the IVI. Just to introduce myself very briefly for the afternoon, I'm part of a corporate innovation team called Resolve Partners. We work with corporates and scale-ups, investors and research organizations to essentially help them to play nicely with each other. And I've been part of the FinTech Corridor for about the last 4 years in its creation across Louth, Meath, and then extending across the border and going from Dublin to Belfast. And as Grace said, I currently sit on the advisory board. So it's supported by Intertrade Ireland, and it's the primary cross-border FinTech cluster, and it's made up of a group of FinTech companies and stakeholders. So from large corporates to startups and scale-ups, to academic institutions and research organizations and economic development agencies, stretching from Dublin to Belfast. So that stretching between jurisdictions gives a lot of advantages for companies to do some shared learning and shared commercial supports for each other. So if you want to connect with the FinTech Corridor or you want to know a little bit more about the work that we do, contact our program manager, who is Hilary Moran, and you'll find her at hilary@thefintechcorridor.com or go to thefintechcorridor.com and become a member. The format today of the talk is we have 3 guests, as you can see on screen. Michelle from Gecko, Paddy from Vesta, and Liam from Waxman. And they're going to take us through a short overview of themselves and their company and some perspectives around fintech and trust and payments. And then we're going to open it out into a much wider question and answer session, some of which we'll try and have an argument between our panelists themselves, and some of which we'd be really delighted if the audience wanted to put questions into the Q&A button at the bottom of the Zoom screen. If you put your questions in there, we'll catch them and we'll triage them out into the conversations. So first up today is going to be Michelle Maguire from Gecko Governance, and Gecko is a data platform that tries to support the financial services and fund industry, trying to help them to meet a lot of their compliance pain points. Michelle will tell you much more and much better about it than I will. Michelle, over to you. So Michelle,
apologies. Thank you for the intro, and you did a great job in explaining what Gecko is. If you just bear with me 1 second, I will share my screen and I will take us back. So I'm delighted to be part of the panel today to discuss the future of digital payments. My own personal background is that of legal, risk and compliance. So I've spent upwards of 15 years, so I'm really showing my age, in various different roles in financial services, managing risk, compliance and legal obligations. And Gecko as a business obviously supports the need and the management of compliance and regulatory obligations in many different financial services arms, which gives lean to a lot more trust in the sector. You know, today's session isn't without a shameless plug for the company that I work for, and it's a great opportunity to get the message about Gecko out there. I've really only got about 10 minutes per speaker, so I'm not going to go into great detail. But fundamentally, we were founded in 2015, and as Alan says, Gecko stands for Gecko, our governance engine for compliance, knowledge and operations, and not the little lizard that everybody thinks it is, despite the logo that we have. We are an end-to-end cloud-based workflow solution. We make full use of a suite of APIs, and it allows our client companies to take full control of task management, project management, legal and regulatory obligations, etc. We are very fortunate to be an Enterprise Ireland portfolio company, and that allows us to have reach into New York and Australia, where we also have offices. One of the many things that makes our tech and our team unique is that we are hybrid. So a portion of our staff have all been industry veterans, and the other half are technologists. And that really allows us to understand our client pain points, keep on top of the challenges and the changes in the regulatory environment, because we know they're constantly changing. Where we started, for any of you who have ever worked in financial services, you know that spreadsheets are just part of the job. You know, they absolutely serve a purpose, but they're not without flaws. And I'm pretty certain we've all had a day from hell where a spreadsheet's corrupted, collapsed, or just crashed on us. Going back to the theme of trust on today's talk, companies that use technology to manage these things add an additional layer of trust, both for their clients and their regulators. And really, as you can see here on the screen, the spreadsheet, something we've all lived. We've really just replicated that into a dynamic dashboard that's customizable to the end user. And it's a low-code, no-code platform. That means you're not shackled to IT or Gecko to manage or change how the environment works for you. And fundamentally, we can save you upwards of 30% of valuable time once we move you away from spreadsheets. It goes without saying there's several regulatory and industry challenges for client companies. You know, evidencing compliance, it's not enough anymore to say that you are compliant. You really have to prove it. You have to be able to say to a regulator, yes, I have done this. And, you know, the fines speak for themselves. In 2021 so far, there's been $5.6 billion in fines, and that's continuing to grow. We even see here in Ireland, our own regulators are taking you know, a really stern view on individuals on different industry types and really making their presence felt and known. And they're not afraid to fine companies. They fined Amanco €385,000 only in the past 2 weeks for failure to manage oversight obligations. I'm not going to labor on these slides, but really how we meet the challenge and our key features. We automate workflows, we centralize dashboards, we've got a document repository, we can request, send and deliver files, and we can customize your reporting. All the sort of manual day-to-day activities that staff really don't like to do. It eats up a lot of time and it can be a very burdensome job. This means that everything's centralized, accessible, very, very easy for the end user, and then, you know, you're keeping your regulator and indeed your client satisfied. Key benefits, you know, you have your compliance footprint. We can implement very quickly. As I mentioned, we are API centric, and I will speak to this a little bit later on why I believe that this is the future of fintech, regtech or insurtech, or the many different types of tech that are now emerging in the economy. And it just allows for quick and easy setup for clients. Again, automation creates many efficiencies for staff. Everything's at a click of a button. And in the world that we're living in now, where we're all disparate and remote, it means that the management of the workforce and resources is so much easier when you're able to go into a centralized platform and take a look at what's going on. Lastly, they're just some of the really nice graphics that my marketing team have put together, really just demonstrating efficiencies, visibilities about files, security, etc. I will point out through our relationship with the FinTech Corridor, we do get access to a significant amount of AWS credits. And we do use AWS as the backbone of our business, but by virtue of our membership of the FinTech Corridor, this significantly lessens the burden and the cost that we face in trying to run this platform. So it's one of the key benefits, getting a plug in there for Hilary and our team on being a member of the FinTech Corridor. So I guess the real reason why I'm here today is to give you the Gecko perspective on the future digital payments, trust, compliance and innovation. The market's moving very swiftly. Technology, different types is emerging every day, be it from cryptocurrencies, instant settlements through blockchain, smart contracts. Sometimes the array of technologies and the possibilities of them is dizzying, and it's a lot for everybody to keep up. It goes without saying that more often than not, the regulatory environment is not as quick to keep up, but we absolutely do need our regulators to be involved to protect the consumer. I wanted to talk briefly about Ireland and why all these great companies are setting up in the Irish space. It goes without saying, you know, we've got PayPal, we've got, you know, Facebook, we've got all the other big, you know, kind of technology firms incorporated in Ireland. We've got Revolut at the moment that is trying to get a banking license from our regulator. We've got Starling and N26 that are looking to the Irish market. We are a sophisticated island in terms of fintechs and a payment ecosystem, and there's a lot of local expertise. We are also heavily supported and championed by Intertrade Ireland and Enterprise Ireland. They do a great job of wearing the green jersey internationally, and you know, bringing the reach of the RegTech and the fintechs internationally, and we've had a great experience in doing that. One of the key benefits I find of Ireland and being involved in this ecosystem and community really is the professional working groups like the FinTech Corridor, like the clusters that exist in the Southeast and all the other parts of Ireland. We work and we communicate and we collaborate together, and it's really, really important for the future of fintech and payments in Ireland. Again, as I mentioned, we have a thriving ecosystem. This is literally on your screen, the Indigenous companies that have emerged over the past number of years. There are other maps for the internationals and you know, the ones that are looking to come into Ireland, but these purely are homegrown Irish companies. Some of them are unicorns like Finergo that you'll all recognise. It is one of our big success stories in Ireland, and they still do great things for the sector and the ecosystem, and are very involved with companies like myself and the professional groups that we're working with. I really believe that the future of the fintech ecosystem relies on interoperability. Fintech firms that will work together and support each other will be big winners in the space. I talked a little bit about APIs a short while ago, and an API really just means that two pieces of software can work together to deliver to the customer something that they demand or expect. Where partnerships form and banks and fintechs and regtechs work together, the better the products and the services will become available to the consumer. Again, I know I keep talking about it, but the FinTech Corridor is a good example of bringing these companies together. More often than not, there's sidebar conversations that happen, or there's ideas exchange that means that two companies can collaborate together to give a client something that they desire. More often than not, a regtech or a fintech may not be able to provide everything that a client expects. And likewise, a client may have invested significantly in a piece of technology they don't wish to drop in the longer term. So by being able to work together and interoperate, it will further drive digitization of the fintech, the payments, and the financial services sector. So what are we likely to see in the future? Open banking continues to grow. We've all moved a lot of our habits online. There's much more online shopping. There's many more online payments being made. You know, even the amount of money we can tap on our cards has increased by virtue of COVID. It has drove a lot of us online. And really, consumer protection and cybersecurity will be an item that features highly on international regulatory agendas. FinTech is the greatest productivity tool that banks have ever known, but it is up now to the banks to leverage that. We see players like Revolut and N26 coming into the market. It's also driving our pillar banks to offer us better services, better applications, better interfaces, so that we have a better overall experience in managing our money. I'm no PSD2 expert. I know Paddy is going to speak a little bit about this because this is really what where his company plays in the market. But really, it's allowing third-party developers to build new services around existing institutions. So if you think about the institution like being a rail, and then they bring other pieces in and tie the puzzle together, really the people who benefits is the consumer and the end user. PSD2 is allowing us to do that we can work together and that services around existing products can be improved upon. And in the industry, which generally is very conservative, may start to move towards innovation. APIs, blockchain and cryptocurrency, 2 of the 3 are highly controversial, and Liam, not that Liam's controversial, but Liam is much better versed in cryptocurrencies than I. But blockchain and APIs are something that are of great interest to me and great interest to my company. I do think, as I said, APIs will be more pervasive. We will streamline processes to increase productivity and probability. But I do believe in the coming years that blockchain will shed its image as solely being associated with cryptocurrencies. There really is a mistaken attitude in some sectors that blockchain equals crypto, and that's strictly not true. Blockchain is the underlying technology, and it has many amazing uses that the industry is starting to wake up and see. It's being used in the aviation sector. We can look in the financial services sector to say, okay, maybe we can better secure data here. Maybe we can use smart contracts to execute settlements or sign agreements in a very secure fashion. And I do believe that's something that will come forward as people better understand the technology. It becomes more stable and it becomes more broadly and widely used, particularly as banks and financial services innovate and upgrade their systems. I'm going to touch briefly then on cryptos. It is a hot topic of conversation. We do see Stripe has re-entered the crypto market after trying to exit it 3 years ago. So seeing that companies are coming back and thinking, hang on, there really is a market for this. You know, that people are still using this, they're still investing in these currencies at, you know, somewhat of a great risk. But, you know, they're still there, they're still emerging, and there's lots of amazing use cases for them. If we look to take that a step further, you know, decentralized central bank currencies are something that's high on the agenda. JP Morgan used tokens, if you will, to settle payments amongst their institution. And there's a lot more of the bigger players starting to look to cryptocurrencies and tokenization as a means of payment. Lastly, regulation. With innovation comes regulation, and that's, I guess, as much of a certainty as death and taxes are. Our regulators need to regulate to protect the consumer, but the big question for the industry, for all of us working in the industry, is whether the approach to regulation will be balanced insofar as it allows innovation to flourish, allows fintechs to remain competitive. And there are 2 key things for those of us who are actively working in the industry. We all know that regulation tends to be a little bit behind and sometimes reactionary. And I do see a swing and a move to look to regulate this space, the cryptocurrency space, or indeed any of these new really smart innovations that come along. The hope is for the industry, and obviously as a compliance provider, somebody who helps companies manage compliance, regulation is good, but we want it to be at a point where it doesn't stifle innovation. And that is pretty much it from me. Happy to take any questions, or if anybody would like to contact me after this, you'll be able to find me on LinkedIn.
Thank you very much, Michelle. I think for really interesting overview to go straight into the fintech world and bringing this FinTech Corridor partnership to IVI. I think we're already getting a sense that as one of the biggest industries that was first to digitize, with bringing a lot of the change, it's bringing a lot of its regulation, which is going to be strong regulation because of the impact it has on consumer finances. And it's probably something that a lot of other industries maybe haven't seen yet in their own industries. If I'm making chips or if I'm making a software as a service type product, and as more industries get digitized, we're going to see more of this type of impact that the fintech industry has already been seeing. We'll take questions and open up Q&A for everybody, for all 3 of our speakers at the end. Don't forget to the audience to maybe drop your questions or your comments into the chat and the Q&A box at the bottom. For another perspective on some of that regulation and some of that trust, our next speaker is going to be Paddy Began from Vesta Payments. And Vesta is their transaction guarantee platform when you're buying online. And I think when you think about guarantee, a fintech corridor or fintech people would automatically start thinking about fraud and how to and the impact of fraud and online transactions and trust and authenticity when you've got an intermediary like Paddy who's guaranteeing the transactions. So Paddy will do a better job again of telling you about it than I will. If you'd like to share your screen and come off mute and tell us a little bit about your perspectives. Thanks.
So if you can tell me if you can see my screen.
We can, yeah, that's fine.
Okay, so I suppose I'm going to talk primarily about my area of expertise and experience in the kind of B2C space, in the customer not present kind of payment area. So firstly, I'll just do a short overview on if I can get this to change, on Vesta. So is that changing?
Perfect. Yeah, slide 2.
Yeah, so Vesta, we're a US multinational. We've been in the, I suppose, card not present space for about 25 years. We set up here in Dundalk in Ireland just about 16 years ago. And effectively what we do is we try and help merchants maximize their payment approval rates for digital payments without the fear or cost of fraud, where we sit in the middle, give instant risk decisions and assume the fraud and chargeback liability with those transactions. Our platform itself is, apart from just payments, we provide an end-to-end holistic solution which really covers all the touch points. So account level fraud from digital onboarding, so customer ID verification, seamless onboarding, in-life account monitoring for things like policy abuse, account takeover attacks, right through to, as Alan mentioned earlier, some of the kind of transaction level fraud, where we will use our technology, consortium data, etc., to make an instant risk decision. And the way our model effectively works with some of our merchants that we work with is we only get paid for approved transactions. So if we don't guarantee the transaction, there's no cost to the merchant. So it's our interests are aligned with the merchant in that we both want to maximize approval rates, but also improve the customer experience, remove that point of friction, which we're going to cover on 3D Secure later, and really let our merchants focus on things other than fraud and how to grow their business, and let us manage that as a managed service. And we do that. So we do that through a number of ways. So we have advanced machine learning algorithms, which we've built up, patented technology. We use things like in customer or device fingerprinting technology, where we monitor transactions in real time for keystrokes and things like that to make sure that it's not a bot and it's actually the person we expect to be completing the transactions, looking at IP addresses, for example, of the customer versus where the card might be registered. And we have, unmatched consortium data effectively from providing these type of services in, a plethora of digital verticals globally, from everything from mobile top-ups to gift cards to money remittance to online retail. And that's kind of how we do it. So some of our customers are some of the companies here in Ireland or in the UK, like Vodafone Group, BT, and we work in the ride-sharing space with a company called InDriver. We've partnerships with Fiserv, where we're providing a white label guarantee service to their merchants in Latin America. So where they have either approval rate problems or fraud problems. We've partnerships with Plaid to provide ACH guarantee in the US. And we also work with some of the gift card players, mobile gift cards, as I said, money remittance. So we're also provide services into companies like Western Union for IVI money transfer. So that's the plug and Vesta overview a bit covered. So I just wanted to give my perspective from a consumer payment perspective, where we're going. And I'm kind of focusing on, as I said, I think we're going to cover the open banking, blockchain, crypto stuff later. So I'm really just talking about the customer not present kind of card. We all know credit, debit card kind of schemes. So the first thing I suppose I'd say is, there's been I think Michelle's covered it as well, there's been a significant shift in consumer behavior. And that's been accelerated through the, COVID. So the first one is obviously cash to contactless, gained significant momentum due to speed, convenience, security, customer demand, government and issuers alike increased the transaction limits for contactless to reduce friction at the point of purchase, and also for trying to get customers through shopping experience quickly and safely, from 30 up to 100 in some markets. If you look at online sales, I think it was touched on earlier. So e-commerce was growing fast before COVID, but the pandemic has really helped fast track the shift to global sales. So if you actually look at global sales in 2020, they increased by 25% to 4.2 trillion, and expected to grow another 17% in 2021. Companies like Amazon, profits increased by 200% over that period. And I know from being in Atlanta last week on a flight with only 50 people on a jumbo, there was no people, but on the way back, it was full of cargo with Amazon deliveries coming back to Europe. And that's the vast majority of the stuff that's actually filling those planes at the moment. The trend can be kind of seen across the board in verticals like home delivery of grocery retailing, fashion. So I have a wife and daughter, and can vouch for the fact that every day like clockwork, I feel like I know our DPD drivers' family history at this point, with stuff coming from Boohoo or all those other ASOS or all those other companies that are delivering clothes. Online gaming, streaming services like Netflix and Disney Plus. I think I heard something last night which said that over the last 4 years, the streaming services, the bandwidth used has gone increased by 400%, and it's Disney expects it's going to increase by another 300% in the next 3 years. New services, ones which are like high-end restaurants delivering meals to homes. So one of the ones in that space, that's in London, it's in Dublin. So one of the ones were companies like Supper, which are just set up in London, where you can get high-end meals delivered to your house. You're paying in a card not present environment, and there's lots of those startups which are really growing. I suppose as we enter the hopefully, I'm not sure what the announcement today, but as we hopefully enter the post-pandemic world, we think digital interactions will continue to accelerate, and buyer not present payments will have an even bigger share of the payments pie. So the question then is, I suppose, what does this mean for retailers and merchants? I suppose for retailers, it means that they must keep pace with payment technology and consumer preferences. I suppose equally important is the technologies available to facilitate safe, secure, and seamless checkouts for their customers and their business. One of the things we think about is, everyone, when you think about fraud and the images that represent fraud, is always that it's this kind of faceless guy in a dark hoodie in front of a laptop screen. That's the kind of image you see, or it's the guy in a black and white striped t-shirt with a Dick Turpin mask with his hand in your back pocket. But it's actually really, if you think about it, it's important to remember that digital fraud is a big business run by large corporations internationally, like any other legitimate business out there today. And the individuals who work there are not that different from you or me, in that they get up every morning, make their lunch, say goodbye to their wife and kids, and go to work hoping to try and find new ways to fool the system. And it's a full-time job like any other job. They're advertised, roles are advertised in complex fraud rings on the dark web and recruitment sites with interviews just like any other thing. And it's kind of important to think about that, rather than, that's the way it is. And as long as there's millions of transactions being paid for through exchanges online, there's always going to be people trying to figure out how they can earn a living out of I suppose, cracking the system. In Ireland alone, like, we've been seeing the wave of SMSs and emails that you're getting now pertaining to be a delivery company that tried to deliver something, or there's someone saying that it's your bank and that you need to click on some kind of link because you've potential fraudulent activity. And we've actually seen that the average cost to an Irish person for a fraud attack like that, it's over €5,000. So it's a pretty big issue. So one of the things I wanted to cover on the next slide was really around 3D Secure, PSD2. It's one of the forms of customer authentication. So I'm sure a lot of you heard of 3D Secure. It's that kind of pop-up thing that happens when you're on an online payments flow, when you're looking to buy something in an online environment. And 3D Secure, it's not a new thing. It's around since 1999, designed for your desktop. But it's been kind of updated as part of the revised PSD2 EU legislation for electronic payments. And now, effectively, it's required or mandated by the issuers where you want to complete a purchase online. So 3D Secure is a form of two-factor authentication designed to protect the card not present transactions online for the card holder, for the merchant, and for the bank. So the first thing I want to say, as I said, is it's now mandated. The previous version had lots of issues. Static passwords you had to remember yourself, which you forgot. The merchant could decide whether to turn it on or off, or on or not. Browser compatibility issues, abandonment rate issues. And the new version now, it's the issuer that determines whether you're actually going to get challenged or not. So it's not your choice to whether you're going to turn it on or turn it off. The experience is improved significantly in terms of, a lot of you'll see now, it's a one-time password sent to your device. You get challenged less frequently. It's frictionless for up to 95% of, it depends on the vertical and the risk profile, but it's kind of well known and accepted by all stakeholders. But one thing to say, just to cover before I go into that there's also some options here as well for exemptions which merchants can also avail of or look to avail of. One is where transactions below a certain threshold. So if it's under 30, or if your 5 last transactions have not exceeded a value of 100, you can look for the option to bypass 3D Secure, where the liability remains with you. If you pass 3D Secure, the merchant liability shifts on, so it shifts away, so you have full liability cover for the transaction and for the chargeback. Another one would be where the bank's overall fraud rate is below a certain threshold, so it could be 13 basis points, 6 basis points if it's if it's under 250. Another area is merchant initiated transactions, so where the customer is not present at the time, so the customer can complete a challenge. Scenario here could be a recurring payment or an installment or a batch payment where the customer can complete the challenge. So there's no liability shift to the merchant, but you get you avoid the friction of 3D Secure. Non-digital channels like live agent, IVR, SMS payments, again, are ones which you can't support with a 3D Secure challenge. Or the last one, which sort of goes back more like open banking, is trusted beneficiaries, where effectively the customer decides that they're going to trust the other party, and therefore they allow to basically say that I'll assume the transaction liability in future and I won't have the ability to file a chargeback. One thing about this is, so it's a better journey, and it is how regulation's going. I suppose you could say it's not foolproof. So one of the issues you can experience here is SIM swap attacks, or SIM swap or man-in-the-middle attacks, where someone else gets a mobile number and they can intercept the one-time password if they have a stolen card to access your account. And one of the things I suppose we're looking at as a future option as to how to deal with that type of issue, and also high value transactions or higher risk, is the potential to marry 3D Secure with some kind of biometric authentication. So you'd have a step-up authentication mechanism, and a scenario there might be a transaction of €1,000 for a high value good, where you're on a flow, you've passed 3D Secure, but then it sends you a message to your mobile with a step-up authentication where you need to upload your driving license or passport through an app, and potentially do a liveness check, which is verified in real time against that type of transaction. So that's a way of either eliminating passwords or putting the two together. So there's some companies using things like this. So for example, in the Irish market, a lot of people would know One for All. One for All is where you can get a gift card, can be used in lots of different retailers. And lots of companies provide One for All gift cards at Christmas, where you're getting a bonus which can be tax-free up to €500, for example. So one of the ways they're doing that is that you get your card sent to your home with the value on it, but you have a QR code which is attached to the gift card you receive. You need to scan that QR code, and that will launch the app where you need to authenticate yourself for kind of light touch AML, put your driving license or passport and do a liveness check. And once you've passed that authentication step, that then sends an API call back to One for All to activate the credit or the balance on the gift card. So that's one. The only thing I suppose I'll just finish with is talking about biometric authentication. I think it's something that we're seeing lots of different use cases on payment flows or on digital onboarding flows. I suppose the feedback from us, or we're seeing at the moment, is there's still an issue with consumer trust. So consumers, I think 45% of people still don't trust biometric authentication and prefer to have passwords. So this creates a challenge. I think that, I think how we use biometric authentication with things like, other forms of two-factor authentication for 3D Secure for some of those use cases I've covered. I'm sure there's other questions which will come up on some of the other future technologies or payment methods, but that's all I was hoping to cover on this. So thanks for your time.
Perfect. Thank you very much, Paddy, for again that deep dive through the industry and how that trust is working or eroding. I think we're going to be reflecting on that in our next talk as well. You might just unshare there, Paddy, when you get a chance. I thought kind of a couple of the interesting things that I picked up straight away, and again encouraging everybody to drop your comments and questions into the chat and question boxes at the bottom. I think in an established industry like e-commerce, to have 25% growth in a year and 18% growth in a year is kind of off the charts. And I saw it in an anecdotal perspective where there isn't a van to be hired in the country because of all of the deliveries, all of the online purchases that are coming in, and that there needs to be a system and a process behind that, keeping us safe, keeping the companies safe too. Thank you for that, Paddy. Going to move to our third and final speaker today, Liam Murphy from Voxman. Voxman is there's going to be a different perspective on some of the trust topics that we've been hearing about today. Voxman is a communications strategy consultancy that works with a lot of technology companies around the world, as we'll hear. I think we're going to hear a little bit more about some of that Bitcoin and blockchain perspectives and where that might be coming from. Liam, take it away. Thank you.
Yeah, thank you all so very much. Can you hear me okay?
Yeah, that's working fine.
Perfect. So thank you all for taking the time to attend. My name is Liam Murphy. I'm Managing Director of Voxman EMEA. We are a strategic communications firm focused on cryptocurrencies and blockchain predominantly. We've over 100 employees globally across Dublin, Singapore, and New York. And the fun thing about what we do is that we launch and communicate the value proposition of products and projects who are doing and who continue to do things that have never been done before. And that's a tremendously exciting proposition for us. So let's get rid of this. So yeah, so we work with many of the largest projects in the blockchain universe. So platforms like Cosmos, Stellar, or Cardano. Anyone who's involved or has a touch point with blockchain or the cryptocurrency sector would be familiar with those, and consortia like Or3 and trading platforms and exchanges like Bitfinex and eToro, for example, who we would have launched in the United States. So this panel is focused on trust and innovation. So as a result, I'd like to begin by looking at the nature of trust globally and ask the question of who do we in fact trust? And what we find is that trust in traditional institutions like media, like NGOs, like government, is actually really low, right? Barely a majority in most cases. It's actually, so there have been some slight discrepancies over the last year or two, but broadly speaking, it's declining year over year. And what's really interesting from this too is that business is actually more trusted. And that's an extraordinary proposition, that business is more trusted than government or the media. And this has huge implications for how we eventually interact with the world. So let's look specifically at one sector in business, and that's financial services, which is relevant today. And we see here too that trust is in terminal decline. In fact, it's distrusted in 10 countries, and that includes Ireland. I mean, that's absolutely extraordinary that only 38% of the Irish populace actually have trust in financial services. So the raw fact that we can deduce from this information is that the financial services infrastructure across the globe does not inspire trust, unfortunately. And if we take another deep dive into the subsectors of financial services, we see that barely a majority trust most financial services verticals, which is extraordinary again. I think it's perhaps noteworthy that digital payments engender more trust than do some legacy verticals such as banks. And I think this is really important because of the topic of today, because of what Paddy and Michelle have just spoken about, but because we increasingly live in a digital world, and our interaction with that digital world in the form of digital payments or otherwise will have significant implications for all of us. So I'd like to look at the concept of power, right? And note here that the power in the world is changing. We see here that big tech has displaced older industries at the top of the S&P 500. We see here that in 2020, Apple, Microsoft, Amazon, Google, and Facebook had 21.7% share of the S&P 500. And what I'd like you to note here is that this is a marked change to the type of company that dominated the top spots of the S&P 500, where they represented the largest companies in the world. And what I can deduce from that is that the most powerful companies in the world now are intermediaries, right? The most powerful companies in the world control our access to our digital and financial lives. And to get a better sense of the power of big tech here, we can see quite clearly that big tech has financial power that equals or eclipses many nation states. Amazon, Google, Microsoft, Apple, each individually have a market capitalization that exceeds Ireland's total wealth. And that in itself is extraordinary. So all of this is to say that this is a digital world we're living in, right? And so the rules of the game for the world in which we live has changed. So digital innovation is fueling the creation of more and more financial intermediaries. I know Paddy spoke so well on this only a few moments ago. And these intermediaries are fundamentally gatekeepers, right? So we can't engage with the digital and financial world without them. And that requires trust. So we need to trust these intermediaries, or else how can we have confidence at all in this new digital world, in digital finance, in digital payments. And what I'd say here is that the costs associated with our reliance on intermediaries is often unseen and involves hidden costs such as losing agency over your own data, such as privacy loss, such as manipulation that can take various forms. And I just have here a smattering of a few examples of how some of these intermediaries, granted not all solely financial intermediaries, have gotten a slap on the wrist, having abused their power. So how do we claw back some of that power? How do we ensure that we can trust the systems that we interact with? One answer, and it is certainly not the only answer, is blockchain. So at its most fundamental, at its most basic, a blockchain removes the reliance on intermediaries who may not have our best interests at heart. As the slide title suggests, blockchain is a trust machine. You can call it a confidence machine, right? It gives people the confidence they need to interact with digital finance, with digital payments, or at least it can. It facilitates, it verifies, and immutably stores peer-to-peer transactions. And again, peer-to-peer transactions, right? With the removal of intermediaries. And it does so in a safe and secure way. It's the technological manifestation of the belief that we don't have to rely on intermediaries to access digital finance, or to rely on banks either to manage our financial lives. And again, to what the other fine speakers are saying, there are obviously lots of guardrails we can put in place if we are to rely on those financial intermediaries, but just proposing a potential alternative here. And obviously I have one slide explaining this, and we could talk for hours, but conceptually blockchain really is just so simple, and it makes financial sense. Blockchain really does make financial sense. So here are just a list of some of the ways that it does. Let's just take two of those that are listed as examples. So efficient cross-border transactions. Blockchain enables instant finality, right? I'm sure people on this Zoom call have tried to send money to the United States or to further afield. It takes a lot of time. That can be gotten around with blockchain, and also facilitates low transaction costs as well. It's simple, but it can be world changing. Another, and I know Michelle spoke of smart contracts as well. Blockchain smart contracts can have a very profound impact on our financial lives, on other aspects too, but in this instance on our financial lives. They automate the payment process according to rules built into the technology, and thereby they preserve this trust. So say, for example, I receive a product from you, it's logged, you get paid. It's simple, but it's really, really effective. So to kind of sum up here, what I just say is we are experiencing a digital revolution. A key example of this is how crypto was a €5 billion industry in 2015 when Waxen was formed. And the extraordinary thing is that it has now eclipsed €2 trillion in market capitalization. So like it or loathe it, the industry can no longer be ignored, and the technology on which it is built can't either. Primary example of this is DeFi, or decentralized finance, right? It has changed how we interact with and understand finance from its most basic elements like payments, like lending, to the development of sophisticated, transparent derivatives markets. And we see unprecedented institutional participation, right? Everyone's heard of MicroStrategy, of Goldman Sachs trading desk, of Even JP Morgan, run by Jamie Dimon, who does not believe in crypto at all, offering crypto to their clients. And I think there are, maybe we can speak about some of these a little bit later, so there's some very large developments on the horizon, from crypto ETFs to CBDCs that can really and will profoundly shake up the global economy. And we see over 100 jurisdictions already having taken steps towards regulating this new digital payment sector. And I'm conscious too that in this presentation I've probably narrowed it a little bit too much, but that's just reflective of perhaps the sector that I work in. But this is happening, and it's really, really exciting. And the regulatory environment is certainly taking note. So that's just a broad overview from me. I'll leave it there and look forward to having a discussion and answering some of the questions that are put forward. So thank you so much.
Thank you very much, Liam. You might just unshare from there you are. So thank you to Liam, to Michelle, to Paddy for your talks this afternoon, really illuminating across some of the key themes and key trends as you see them. I'm reading a lot of commonality, but it's not all rosy. I'm reading a lot of issues. I'm hearing a lot of issues about trust. I'm hearing a lot of issues about regulatory impacts. I'm hearing a lot of new innovations, new technologies, cryptos and blockchains, and how they're going to disrupt. So going to pick apart some of those themes as we chat through about the next 20 minutes, 25 minutes or so. Just a call out to all of our participants who are watching. It's great to see that thank you for joining us. Great to see you all there. Throw in any comments, chats, arguments, disagreements that you have with any of the speakers. They're all well able for it. So and if they're not, they'll just kind of wince off and tell me to ignore the question. But maybe if we kick off, and I'm going to open it up just to think about this idea of fraud in the fintech sector. So I think Paddy, you were giving us a couple of examples. Maybe we don't see the process when we're making a transaction the way that you do, or the way that the transaction processors see it. Can you give us an example of a typical card not present fraud that you deal with, how you interact with it, how do we feel about it, or how do we experience that work as consumers on the far end? You might need to and probably Liam and Michelle, you may as well probably unmute your mics as well, so that we can all chip into each other as well. Paddy, sorry.
Yeah, sure. So here in Ireland, we deal with a lot of the mobile operators. So UK, Ireland, we've probably 70% coverage of the telcos here, and effectively one of the riskiest verticals there you can think of is prepaid top up. So it's virtual prepaid top up. Effectively, you have a prepaid subscriber, they're not registered, so they're an anonymous customer trying to top up a number or numbers remotely with a card with a value that can be kind of monetized instantly. So there's kind of three types of fraud. There's one which is very hard to defend, which is first party fraud, or the term friendly fraud. There's nothing friendly about it, but it's effectively where the person is who they say they are, and they just decide to charge back a transaction. And typically, even when you provide all the paperwork to defend the chargeback, half the time they go with the consumer anyway, no matter what you do. So that's very difficult to defend, because you are talking with the exact customer. It's not a person with a stolen device or identity. It's actually the person. But I suppose the two ones we would deal with in that space, one would be a fraud ring, for example, buys 1,000 SIM cards on eBay. They have a whole host of stolen credit cards. They top up all those that they purchase in the dark web. They top them all up with, say, £20 or £50 each, and then they sell them at a discount on the high street to consumers who get a good deal. The second one would be same use case, lots of SIM cards. They're topped up with stolen cards, but in this case, they'll ring a premium rate number registered in someone like Uganda, which which could be owned by the fraud ring. So it's international revenue share fraud. The SIM credit then for those premium rate calls is converted into kind of clean, legitimate funds for the fraudster to monetize that. So how we'd stop that is, well, firstly, we're looking at all the different carriers. So if we see one having an attack here, we'll be looking at that in real time and monitoring it. So typically when we stop it there, it'll move to the others. And if we're not looking after one of those carriers, that's where they'll all focus on, which is fine for us, but not so good for the carrier we're not supporting. But we kind of stop it through, as I said, the kind of machine learning monitoring, which is looking at the expected versus the irregular behavior on all the payment channels. We're looking at the device fingerprints technology on the checkout flows. We're assessing things like keystrokes by the user on the various pages at checkout to determine if it's a bot or a real person. We're looking at the IP address. So if we see an IP address of someone who's in Australia, but the card's registered in Dublin, they're all kind of flags that we would check. And then we have, as I said to you, a consortium data, which we use across all verticals, which would allow us to make a call on whether that's a good customer or not. So we're able to reduce false positive and let the good customers come through. And as I said, where we're wrong, the liability sits with us and not the merchant. So that's typically a good example of I suppose, a card not present fraud use case.
And it's interesting. I mean, topical at the moment where you're talking about chargebacks. Obviously, you know,
Ryanair,
our favorite airline, are going through some PR issues at the moment that the Liam Group perhaps get involved with. But I just saw that Bank of Ireland have come out with a statement saying that they owned the problem. So even when it's not fraud, this situation of how tracking the money flows and tracking transaction flows and making sure that the right users get dealt with is still hard.
Well,
and it's horrifying to think, as your point well made earlier on, about these army of, you know, suited and booted professional fraudsters interviewing on the dark web and searching for these points of access that can be scaled.
Well, there's actually an extra one as well, Alan, which is, you know, the merchant gets hit with fraud, but as we kind of covered on the presentation earlier around PSD2 and the exemptions that are available for 3D Secure. So let's say, for example, you're a customer and you do a transaction, or you're the merchant and you accept a transaction through a call center or over an IVR. So in other words, they don't go through the 3D Secure challenge because they're exempted as a one where they can't get challenged.
Sure.
If the chargeback happens on that channel, the merchant gets hit with the actual chargeback. Then there's the chargeback administration to try and defend it or look into it. So all their team's administration time, and they get hit as well with a chargeback admin fee by Visa or MasterCard for £12 to £15 on top of the actual chargeback because you didn't use 3D Secure, even though you're on a channel where 3D Secure isn't supported. So it's a double whammy. You know, it's really.
So the fraud, and then the cost of managing the fraud, and the cost of managing that. So there's a huge, let's say, paper flow. There's a huge digital flow. There's a huge process flow. And maybe, Michelle, if I come to you on that, we heard a lot this afternoon from all three of you about the advances across blockchain. I'm wondering about smart contracts in this sense, particularly maybe more so in a B2B setting. Are they the answer, or part of, or where the opportunities and challenges there?
I mean, the smart contracts, I think, are certainly the future. I think the legal fraternity may disagree with me in the broadest sense of the word. But fundamentally, a smart contract gets executed when a certain set of conditions is met. So if you get a document issued and it says, Alan, please sign this, you sign this, and it goes back, contract executed. And there's a lot of cynicism and skepticism about it, but provided the conditions are correctly coded in the contract, there should be no problem. You know, so I think in the broader sense of the term, if you think about buying a house and all the paper that you've to sign to get your mortgage sorted or your insurance documents and things like that, that's a very, you know, simple way of looking at it. But when we go to the examples that Liam gave about, you know, interbank settlements and how quickly payments to the US could be made, and really cut down turnaround times, cost, admin fees, etc., it really opens up a broader broader use case and broader sort of spectrum for these for this piece of technology. I hear varying concerns about it, but it is in use, and it will continue to be in use. The aviation sector make quite a large use of it right now. But taking it back, I guess, to blockchain, I think blockchain gives that level of data security, and every keystroke of activity that occurs in that block is recorded and then may likely cut down on the admin issues that Paddy discussed, that they have to trawl through and figure out what went wrong. So if there was more use of smart contracts, I think there'd be the trust factor, there'd be security factor, as well as the data protection and data security factor. We live in an era of GDPR where it's cited at every opportunity as a reason not to give information or not to accept information from a person or a party. As we get to grips with this, people will realize that using these types of technology means their personal data, a company's data, and entity level data will be much more secure using these methods than email and the other ways that we share this right now.
Thank you for that. I just, the thought strikes me. I've been working with and investing in some blockchain startups for the last 5 years. I have to give a shout out to our FinTech Corridor. I'm actually undergoing a blockchain course in Dundalk IT at the moment. Probably a few of our companies and a few of our people are on it. Yeah. So big fan of blockchain, but I'm going to come to Liam, and I'm going to maybe challenge a little bit here, because we know the blockchain works. We know that smart contracting will work. We know that the trust and authentication factors are going to be there. But has it been allowed to be corrupted by some of the crypto conversations, or has the conversation been changed so that we now have to rebuild blockchain activities and blockchain applications versus crypto? Liam, maybe unmute. Yeah.
So I'd say a few things. I won't speak about the technology in too much depth. I don't pretend to work in compliance or be an engineer or even from a legal perspective to be a lawyer. But I do appreciate and embrace is the fact that regulation is inevitable, right? Of course it is. And yes, has the crypto economy veered on the a little off track. Yes, the ICO craze of 2017, 2018 was very off-piste and needed to be reined in. Of course it did, because investors and participants need to be protected. You can't have this 2 trillion economy where you have unregulated derivatives and then have the traditional financial economy where you have regulated derivatives that have to abide by the letter of the law. And regulation is very welcome. I actually often think that crypto was like the kids' answer, angry answer to the 2011 financial crash, and now the regulations that are coming in are the adults stepping in again and biting back a little bit as well. So listen, regulation is necessary, but there are both risks of under-regulation, which I think we've perhaps seen thus far, and there are risks of over-regulation, because one thing regulation shouldn't do is stifle innovation. But when we're speaking there, I just wrote down here 3 things that we need to establish in advance of applying any regulation, right? And one is, which regulators are responsible for what? Because nobody knows, right? And this is a huge issue. I mean, the largest or the loudest trumpet is the SEC in the United States, right? It's jockeying for position with the CFTC and other institutions for control, and even in Ireland, right? Vast virtual asset service providers have to register at the central bank, right? That's true, but I don't think there's clear regulatory oversight in any jurisdiction at the moment. That's a really simple place to start. I think secondly, we have to establish what minimum standards must be met for a digital asset or fintech provider to operate in a jurisdiction. At the moment, we don't really do that, right? There's a lot of regulation by enforcement. You've seen stuff that's come out with Coinbase and stuff recently, but what people need to know if they're involved in the space, whether they're fintech or payments or crypto, is what are the minimum standards I need to reach to be able to participate. And thirdly, what role do government bodies and the European Union, supranational bodies like that, want to assume in the new digital economy? We spoke with CBDCs and so on earlier. So that's really important too, because of course they're going to have a role, and at the moment they're on the outside. So all of that is to say, there are some very basic questions that need to be answered before the inevitable and necessary regulation comes in, and I really do think it'll be welcomed.
But I think, Alan, you made a really good point about the synergies that people put with blockchain and crypto. I think the FinTech Corridor and DKIT are doing great things about educating the workforce about blockchain.
Yeah.
Our company actually advised from an industry perspective on that course, and I have some staff on it at the moment, and they're finding it brilliant because it's a back to basics concept and explaining what it's about and use cases. So I think education is key, and the continual education will be key, so that people don't automatically think cryptocurrencies and the dark web and all these nefarious associations with a blockchain technology. And I think realistically, you could actually be engaging in the use of blockchain technology right now, and you aren't aware you are, because technology looks no different with blockchain or without blockchain. Yeah. So I think to shed that image, I think education is fundamental for the financial services sector, but just more broadly as well. Yeah.
I'm actually probably guilty of conflating the two for the purposes of this panel discussion as well. Right, and probably in the public consciousness they are conflated wrongly, as you say, Michelle, because for all the benevolent intention that people have, most people are involved in the space to make money or to lose it, and that needs to change, and it will change, I believe, over time.
And can I pick up on a point that you made, Liam, about regulation is coming? We all know that there's lots of it. There's more of it coming. And yeah, I love me some innovation. But your point that innovation can't stifle, or regulators can't stifle innovation, I think sometimes yes, they have to. It's about public protection and consumer protection. So we've got lots of inflated things in the past in ICOs. Currently, it's happening in SPACs that are getting blown out of proportion. We could have community adjusted EBITDA, or there's that happened to WeWork, or there's another instance at the moment where they've invented an EBITDA without marketing costs for one of the companies that's trying to go public at the moment. So I think some regulation is the right thing, but there's an author that I encourage anybody to pick up on called Azim Azhar, who's just published a book called The Exponential Age. And he makes the point, kind of simple enough point, but he makes it well, that technology is going to move much faster than regulators can keep up with, and that the law can keep up with. We can do things with technology, and we can build into them. Maybe if I come to Michelle, first of all, where do you see that balance between regulation supporting or regulation getting out of the way, or not being able to cope with what you were able to code?
I think you're in danger of giving me a soapbox here, Alan, but it's a fine line. Obviously, consumer protection is key. Technology moves at a pace that none of us really can keep up with. There's always something more clever or more smart coming out. Like AI is now a big concern. Deep fakes and how much can AI be used in wealth management and investment management and things like that. There's a lot of good technology out there, but we have to remember our regulators are bureaucrats and they're civil servants, and in a lot of cases have been a long time out of industry and maybe perhaps don't have the grip on it that the industry would have. So I do think regulators need to engage more with the industry to keep the ear on the ground, to know what's going on. But absolutely, my business's bread and butter is compliance and regulation. So I'm in favor of regulation, but also in favor of, innovation. And I think it's good for our economy that we bring all these smart, innovative companies to the island, from an employment perspective, from a learning and educational perspective. But absolutely, regulation's coming, but it's a hairpin. It's whether it catches up quickly enough, if it goes too far. And you know, we're at a crossroads with that. I mean, the central bank, when the ICO craze was going on, they put consumer protection warnings out. We didn't regulate. You know, SPACs, as you say, are going on now, and there's, you know, everybody's watching and waiting. And I know from experience, a lot of regulation is reactionary, and that doesn't always make for the best type of regulation. So in short, it's coming. What format it comes in, you know, could be a surprise to us all. But I think for me, the key message is that regulatory bodies need to engage more with industry, to fundamentally have a grip on what they're regulating for.
How the hell did I end up on the side of trying to defend regulators and trying to say that they're a good thing, to reel this in? I'm not going to presume, Paddy, that you might agree, but you're coming from a very well-established transaction processing, consumer-facing, things like open banking, things like PSD2, these are opportunities that are, well, am I right? Were they created by regulators and banking authorities that enable all of our tech companies to thrive?
Yeah, I think open banking is you know, it's a real buzzword at the moment. You know, and it is, yeah, it's as I said to you, it's sort of on the tails of faster payments. It's, you know, the use cases for verifying customers with account information services and payment initiation services, you know, are kind of really interesting. But taking it back, as I said, from the kind of consumer side, I think it's still at a very early stage. I mean, I'm not sure the infrastructure's ready or stable. There's the customer experience in terms of a redirect model, familiarity is low. It's not really fit for purpose today for things like regular billing. And one of the things we covered earlier, which was about customer redress, so refunds, dispute processes, it's not really geared up to deal with that, or regular payment flows. So I still think it's a long way to go. I know there's lots of companies getting huge investments, like, you know, Sentinel and TrueLayer and all these others, but yeah. From a consumer perspective, using it in a B2C, the cost isn't even that much cheaper. The whole idea here is it was supposed to be an awful lot cheaper, but when you actually fully load the cost, unless you're doing really high volume, it's actually not much cheaper than the card payment.
Interesting. Okay. Liam, do you want to add any comments on where you like the regulators to get involved with crypto?
Yeah, like, listen, innovation is unpredictable by its very nature, right? And it's important for regulators up to a point to provide guardrails. But say when it comes to cryptocurrencies, for example, which would be my neck of the woods, it's the job of central banks and regulators to ensure that the revolution in digital payments that's taking place at the moment works for society as a whole. One example of that is the role of CBDCs, right? Central bank digital currencies, for example, right? So are central banks going to play a role in augmenting cash with digital currencies, which is really profound, right? So we see it in China already. They already have a CBDC. They're rolling it out. It's going to be the implications of it. We're not quite sure. It's going to be rolled out elsewhere too. What we don't know is what form it will take. Will it bypass traditional financial institutions so that central banks can interact directly with the customer on the street. We're not really sure, but what we do know is we saw issues like with stimulus payments in the United States, where people were posted checks. I mean, I have friends who lived there 6 years ago and were getting checks sent to their old apartments as the way to distribute checks, right? That when we talk about CBDCs, it sounds very complicated. Again, we keep going back to blockchain being conceptually actually quite simple, but it's just the capacity to transfer money electronically in a efficient, workable system, and that's kind of all it is. So when it comes to what role regulators should have, I believe that sovereign currencies should become digital currencies. I think they will, right? We see the Boston Fed in the United States engaging in this. We see Singapore, Sweden, you name it, all exploring this, and the ECB as well, exploring it as well. So huge role to play, but what we don't know is where that road is going to lead.
I think those checks in the States were primarily a function of getting Donald's signature on them.
Yes.
And your point about central banks getting involved in cryptos is well made. I think it was San Salvador who recently announced that they were going to accept it as normal day-to-day currency, and actually it was mostly about getting expatriate funds back and forth legally and properly, so without having to go through lots of other intermediary and transaction systems.
Yeah, Salvador. It was a really interesting one because they've from what I understand, we're pegged to the US dollar anyway, right? So the great attraction of cryptocurrency should in principle be that they escape the volatility of their native currency, but they actually didn't have any currency volatility, nor did they suffer from huge inflation or what have you. So yeah, it seemed to be largely maybe a bit of publicity for the president, and also facilitates remittances. We'll see. It could be a potentially costly experiment. It's definitely one lauded by Bitcoin maximalists, of which I'm not one. I would say. I know that Moody's has downgraded them to junk status, and I think the IMF, obviously, World Bank refused to participate in setting it up, and so on as well. So all that to say is, implement having a currency like Bitcoin that has had such wild volatility swings over short periods, right, is potentially dangerous. But what is the solution to that? Arguably, it is CBDCs, right? It's a currency that is just like the cash we have in our pockets, but it's digital.
Point made. Let me think about maybe closing out with a final set of questions. I'm conscious of our wider audience here in the Innovation Value Institute, and that we're giving them strong perspectives on trust and regulation and the transaction process within the fintech industry. And I kind of wonder, I started off by saying kind of an hour ago that the fintech industry is probably ahead of a lot of industries in terms of digitization, because we have to be. What are we doing well? What could the rest of the technology industry learn from us, from what we're going to be doing or what we've had to do? And the corollary is maybe what are we not doing so well? How could we move better? Paddy, can I maybe throw that open question to you to begin with?
I think one thing that's definitely doing well is getting significant investment. So it's like you look at some of the, like you mentioned Finergo earlier, but some of the unicorns, Klarna, the valuation on Klarna is crazy. I think most investors are also putting their money into things now. Really, it's shifted to AI, automation, digitization, open banking, and more so on the B2B side rather than the B2C side. I think what they're doing well, I suppose, is probably in terms of defining the roadmap for innovation, the direction, the shape, and the pace, and also probably setting a higher bar for customer experience. What they're on the downside, they're probably struggling with more is creating new infrastructure and ecosystems, alternative payment rails. So they're much more successful in improving traditional ecosystems rather than an infrastructure, rather than create new. That's what I'd say.
That's interesting. So I'm just capturing that in the comments. So setting a framework for change and innovation, doing it well, struggling with the detail of it and the actual building of that infrastructure. I think that's pretty interesting. Michelle, maybe do you have a perspective there?
Yeah, I mean, obviously, as Paddy says, the fintech industry is definitely doing well in raising of funds. It's heavily supported, at least in Ireland, by the government. You only have to look to IFS 2020 and 2025 to see that the government itself is really driving the fintech agenda forward. You know, investment in education and really seeing this as a future jobs opportunity in the country. I think in terms of an industry, we collaborate very well. There's a desire and a drive to further the fintech agenda. I know myself, colleagues in the industry, we've got WhatsApp groups and we message about challenges and problems that we have and various different things. I guess what we're not doing so well maybe is getting to work with the big players that are in the market. How can we break that gap between, you know, the small fintechs and the big tier 1 banks that exist in our marketplace, like your JP Morgans, like your Morgan Stanleys or your Citibanks? They all are here and they operate here and their European headquarters are here, but fintechs and smaller fintechs sometimes find difficulties in getting through that procurement and getting through that value chain proposition with these companies. And I think as an industry, we need to figure out a better way forward to make our, you know, as much as convincing our propositions are, we need to convince these big firms that they need us, particularly in the reg tech space. The other thing I think we could probably do is define it a bit better. We've got reg tech, fintech, we've got insure tech, we've got med tech, health tech. It's endless, legal tech, and they mean all the same thing in some cases to all the same people. And it's, you know, like when you think about it, a fintech could be a reg tech and a reg tech could be a fintech. Yeah. So I think as an industry, I think we need to come together better and really, you know, harness that and define that, because, you know, you've got Revolut operating in the same space maybe as Gecko, which we definitely are not. On the same level, but we are defined by the same word. You know, so I think as an industry, we probably could do better at that.
Well, you were the one that showed the Ireland FinTech Map, which had everybody nicely siloed off into labels. I'd encourage all our audience to go back and have a look at that map, and particularly there is a heavy concentration of payments technology companies in Ireland. But I think all three of you have made the point about the interconnection of all of those silos is actually the process behind what it is you're trying to do. Liam, sorry, Paddy.
I was just going to say, yeah. You're just talking about the, you know, traditional versus the, you know, the fintechs or the new players. Like, so if you think about it though, like if you take someone like Monzo, you know, traditional banks are probably coming out with very piecemeal digital propositions. And you know, they need to interconnect probably with some of the newer players, you know, to come up with propositions that work, that kind of best, I suppose, marry the best of both. And I'm not sure. So some are burning through cash like there's no tomorrow, and they're getting new customers. Like Monzo, for example, the cost of acquiring a new customer is, I think it said it was something like 45 pounds per customer. But so it's a quarter of the cost of what the traditional bank's cost of acquisition is. But then in terms of the value they derive per user, it's 20x less.
Yes, so they don't have the full suite, they don't have the full trust, they don't have the full retail presence and so on. So yeah, point made. Maybe Liam, come to you on what our fintech industry, and I know you're going to speak to, probably more so to the specifics around blockchain and crypto. What are they doing well that others could learn from? But what do you need to do better?
They've created fabulous technology from the ground up. I don't know if any of us, myself included, really appreciate what that means, right? We've been working on operating with legacy systems for so long, and you know, this new technology is nimble, it's efficient, and importantly, it's customer centric. You know, most of the big financial institutions or banks, many of which are operating as a result of mergers or whatever, are operating under creaking old IT and infrastructure. I don't know if they will ever be able to do what we as consumers in the 2020s want them to do, ever, right? Like I know, when certain legacy banks bought the loan books or mortgage books of rivals recently, they have to manually input them all one by one, right? It's bananas. So I don't know if they're ever going to be able to do what we want them to do in this decade and the next anyway. So that, I mean, the innovative tech is something to be noted. And then what they're not doing well is perhaps making clear their true value proposition. I'll just use like Bitcoin as an example, but not the only one. Stable coins and so on. We don't know yet if Bitcoin is something that we should buy a dozen eggs with, or if it's something that we should keep in a vault and it will make us millionaires. We don't know that yet, and they're two different value propositions, and no one's quite sure where, how, and when to use them.
That your point is well made. It speaks to the type of work that I do myself, where just because you can build a beautiful product and a brilliant product doesn't mean that you understand your customer, your users, or understand the value proposition. And that's pretty much a mantra that I say every day in my work. So I know a good closing line when I hear one. On behalf of the Innovation Value Institute, can I thank our three speakers this afternoon, Liam, Paddy and Michelle. On behalf of the FinTech Corridor, can I thank the IVI for allowing us to have this kind of shared event and bringing some of our thinking from the FinTech industry, FinTech and payments industry to your wider audience. I hope it's been really useful for the audience. I know it's been recorded and will get distributed therefore. And look forward to chatting to you all again soon and seeing you at different events. Over to you, Grace.
Thanks very much, Alan. And just to say thank you to you as well for an excellent job moderating this afternoon. Yes, and to say thanks very much to all of you for a really great session, really interesting presentations, and a really dynamic discussion as well. So very much appreciated. I think everyone will have enjoyed it. And just to wrap up very quickly, to let you know that the next in our series of webinars will be taking place on November 11th, and that'll be focusing on enterprise architecture. And if you want to keep in touch with ourselves at IVI, if you have any questions or queries, you can get in touch at info@ivi.ie, and our Twitter, LinkedIn and website are up on the slide there as well. And also a big thank you again to the FinTech Corridor for collaborating with us on this. And as Alan mentioned earlier, if you have any queries, you can get in touch with Hilary Moran, who is the program manager at hilary@thefintechcorridor.com, or have a look on their become a member page on the FinTech Corridor website. So thanks everyone again for a great session, and to the audience for joining, and we will see you